Hi everybody, this is lecture 2 for week 6. In the previous lecture, I have explained about adjusting entries. Adjusting entries is the step 5 in the accounting cycle. So the first thing that I have explained is the purpose of doing adjusting entries. I hope you can still remember the main purpose of doing adjusting entries is to follow matching principle. The second purpose of doing adjusting entries is to make correction for any errors that happen in the recording process. And then you have seen that there are 4 main types of adjusting entries. You can check the previous lecture video. So today you will see there are 2 more adjusting entries, 2 more types of adjusting entries. The first one is depreciation. Okay, let's see what is about the depreciation. So depreciation. So the first one that you have to know is asset acquisition. So if you have a business, sometime or there is a time when your business need to purchase fixed asset or non-current asset. Maybe at one time your business need to purchase personal PC or equipment or building or motor vehicle or land, etc. So in accounting we call it asset acquisition. The business purchases or acquires fixed asset. So when a business purchases or acquires a fixed asset, then the value of the fixed asset that has to be recorded should include purchase price plus cost to acquire the asset and getting it ready for its intended use. Okay, see this. See the 2 points in the slide. The value of fixed asset purchased by a business has to include purchase price plus the cost to acquire the asset and getting it ready for its intended purpose or use. For example, sales tax, shipping, installation, insurance, etc. I hope there is an example here. Okay, see here. Let's say you have a business, and then at one time your business has to purchase a sewing machine. So the data is at the bottom of this slide. Purchase a sewing machine for 5,450 and $50 is charged for shipping, and then paid 3,500 cash and will pay the supplier $2,000 later. So how to record if the scenario is like this? So see here, the first thing is the business purchased a sewing machine. The price of the sewing machine is 5,450. But when the business purchased the machine, the business also has to pay $50 for shipping, for delivery, from the supplier business to this business. The $50 delivery cost or shipping cost. So when you want to record the purchase of this sewing machine, the value of this machine has to include purchase price, which is the 5,450, plus the cost to get the machine or to acquire the machine, which is the $50. So when you record in the journal entry, The record is debit sewing machine 5,500. How to get the 5,500? The purchase price 5450 plus the shipping cost $50. So the total value in the accounting record is 5,500. Remember why you debit the sewing machine account? Because according to the rule of debit and credit, when an asset increases, you debit. So the asset sewing machine increases, so you debit account sewing machine. When this business purchases the machine, the business pay cash. Cash is an asset, so that is an asset cash goes out. Asset cash decrease. That's why in the general journal here, you can see that credit account cash, because the business pay cash. There is a cash decrease or cash goes out, 3,500. And the business will pay the balance of 2,000 in the future. So in accounting, always remember, when a business has to pay something in the future, it is a liability. And in this scenario, the name of the liability account is account payable. Always remember, if a business has to pay something in the future to another company or another business, then you record in account payable. So the general journal entry for purchasing this sewing machine is debit sewing machine 5,500, credit account cash 3,500 because cash goes out or cash decreases, and then credit account payable 2,000 because liability increases. Remember this. Okay, these are several things related to the fixed asset or non-current asset. As time passes, see the first point, as time passes, a fixed asset loses its ability to provide useful services. This decrease in usefulness is called depreciation. So in accounting, if you have a business, let's say today you purchase an asset. For example, we use the previous slide as example. You purchase a sewing machine. If you purchase the sewing machine today, the value is 5,500. But after you use the machine, maybe after 1 year, 2 years, 3 years, the value of the machine will decrease because of time. The machine is getting old, and maybe the performance is getting lower. So in accounting, the situation is called depreciation. But that is a simple explanation. If you learn about accounting in more in more detail or in depth, you will find a better explanation or definition for depreciation. Okay, it is related to matching principle, etc. So that is not for your level. That the better definition or the more detailed definition for depreciation is for accounting student. Okay, use this definition at this point. Okay, depreciation. See, depreciation is the process of cost allocation that assign the original cost of plant and equipment to the period benefited. Okay, and then before you can calculate the depreciation, you have to know the book value. The term book value. Book value means the asset's original cost less any accumulated depreciation. And then the second term that you have to know is salvage value. Okay, remember this. Salvage value is the amount expected to be received when the asset is sold at the end of its useful life. In accounting, when you purchase an asset, for example, the sewing machine, after you record the purchase or after you purchase, you have to estimate the useful life of the asset. For example, you just purchase a sewing machine, maybe based on your experience, the sewing machine can be used for 7 years. So that is called useful life for the machine. Maybe a motor vehicle has a useful life of 10 years, maybe. Or a personal computer will have a very short useful life because personal computer always uh, uh, always can be obsolete very fast. So the useful life of a personal computer or PC can be maybe 4 years, 3 years. Salvage value, salvage value is something like this. Let's say you estimate that the sewing machine that your business has can be used for 7 years. The salvage value is the value of the sewing machine at the end of the year 7. Maybe at the end of year 7, you can sell the sewing machine as a second hand item, so it has value. Let's say you purchase the machine today 5,500. At the end of year 7, maybe you can sell it at $500 as a second-hand sewing machine. Maybe that is the salvage value. Or maybe at the end of year 7, the sewing machine, you think the sewing machine is cannot be used anymore and cannot be sold anymore. It only can be sold as a recycled material. So maybe $50 or $30 only. So that is the salvage value also. In some cases, when you have a fixed asset, maybe a big machine or equipment, at the end of the life of the asset, it has no salvage value at all. Okay, so just remember that. Okay, there are several methods that can be used to calculate depreciation for a fixed asset. The typical one, or the the common one, is called straight line method. So this is the for this course, you have to know how to calculate the depreciation using straight line method. Okay, see here. So how to calculate the annual depreciation expense? So in accounting, when the value of the fixed asset decreases, it is recorded as an expense. We call it depreciation expense. So to calculate the depreciation expense or the amount of depreciation, the formula can be seen in the green box. The formula is cost minus salvage value divided by estimated useful life of the asset. See, so there is an example here. The example is, let's say a business purchases a washing machine. The value of the machine is $5,000. And then the business estimate that the useful life of the washing machine is 4 years. And the salvage value is 600. So how to calculate depreciation, the amount of depreciation every year? So the calculation is, has to be, the depreciation expense can be calculated using the formula that you have seen in the green box. So the formula is cost minus salvage value divided by the useful life in years. So cost for this washing machine is 5,000. Salvage value is 600 divided by the 4 years useful life. So every year the depreciation expense is 1,100. Okay, when you have calculated the depreciation expense, this is the journal entry or adjusting entry for depreciation expense. So the journal entry is like this. You debit depreciation expense and you credit the accumulated depreciation. Always remember, the journal entry or the adjusting entry for depreciation is same for all fixed asset. The entry is debit depreciation expense 1,100 and credit accumulated depreciation for the asset. In this example, 1,100. Why you debit depreciation expense? Because in you refer to the rule of debit and credit. When an expense increases, you debit the account. And then accumulated depreciation. Okay, accumulated depreciation is we call it a negative asset account. Why? Because it decreases or reduces the value of asset. Okay, if you have a business and then you have 5 fixed asset. Let's say you have a laundry shop and then you have 5 machines. So if you have 5 machines, then you have to have 5 different account for the machine. Let's say machine A, machine B, machine C, machine D, and machine E. So at the end of every year, you have to calculate the depreciation expense for every machine. How much is the depreciation for machine A, how much is for machine B, C, and D, and E. When you do the adjusting entry for depreciation, so for every machine, you have to do adjusting entry like this. Depreciation expense, let's say for your machine A, depreciation expense 1,100 debit. Credit accumulated depreciation, and then you have to write for machine A 1,100. Let's say for machine B, you have calculated the depreciation, and the depreciation for machine B is 2,000. So how to record that, or how to do adjusting entry for depreciation for machine B? The journal entry or adjusting entry for depreciation for machine B is like this. Debit depreciation expense 2,000, credit accumulated depreciation for machine B. Accumulated depreciation account is specific for every fixed asset. You cannot use only one accumulated depreciation account. No, every fixed asset must have accumulated depreciation accounts. Depreciation expense is only one account. All depreciation expense has to be recorded in only one account. I hope I can show you later when I prepare a sample question for you. Okay, the next thing is accounting or adjusting entries for supplies. Remember this, supplies are items that a service business use when the business provide services. Let's say you have a laundry shop, then supplies are detergents, softeners, and other things that you use when you provide the laundry service. Let's say you have what else? Let's say you have a printing business. A printing business is a service business. Let's say you have a t-shirt printing business. So what are supplies for a t-shirt printing business? A t-shirt printing business, the supplies are the dye or the color that you use to print the t-shirt. That is an example of of a supplies for a t-shirt printing business. Another thing is, I think you have to use what else when you provide a t-shirt printing business. I think they will use a silk screen or something, silk screen to do the t-shirt printing. So if the business uses silk screen, then the silk screen is also a supplies. Okay, so that is the definition for supplies. So I hope you can understand that. And then, okay, remember this. Let's say you have a laundry shop. Supplies on hand are an asset. Supplies used are an expense. So if you have a laundry shop, when you have the supplies in your shop, you have the detergents, the softeners, etc. When the supplies are still unused, these supplies are asset because these supplies are resources owned by your business. Okay, but when you use the supplies to provide the laundry service, it become an expense. Let's say today you started a laundry business and then you purchase the detergents, the softeners, etc. $1,000. When these supplies are there in your business, they are asset. But when a customer come and you use $10 of supplies to provide the service, to provide services to this customer, then the $10 is an expense. We call it supplies expense. Now your asset decrease. Before the customer come, you have $1,000 supplies. When the customer come, you use $10 to provide the services. So now the $10 is an expense. Supplies expense is $10. Your supplies asset decreases by $10. So now your supplies asset is supplies asset 9,990 because you use $990 only because you have used $10. Okay, so how to do the adjusted entry for supplies? So let's see the example here. Your supplies account has a balance of 2,000 in the unadjusted trial balance. So the situation is like this. Let's say at the end of the year, you check your supplies in your shop. The total supplies that you have is at the beginning of the year, you check the supplies that you have in your shop. You see that you have supplies with the value of $2,000. And then during the year, you have used the supplies. And then at the end of the year, you found that only $760 of supplies are left on hand or in the shop. So if that is the situation, see the calculation, the simple calculation below. Supplies at the beginning of the year or on trial balance is 2,000, and then supplies at the end of the year is 660. So from that number, you will know that now you know that the supplies used during the year is 1,240. So remember what I have told you earlier. Supplies, if you have them in your shop, they are asset. But when you use them, they become an expense. So supplies, at the beginning of the year, the business has $2,000 supplies. At the end of the year, the business has only $760 of supplies. So the business know that during the year, 1,240 supplies have been used. So the surplus use is the surplus expense. So this is the way to record the surplus expense or adjusting entry for surplus expense. So at the end of the year, when you close the account, the adjusting entry for this the surplus expense is like this. You record the surplus expense. So in accounting, the recording of the surplus expense is done at the end of the year, not every day. Like I said earlier, you have a laundry shop. When you provide services to your customers, you use the surplus. You don't have to record the surplus use every day. You record the surplus use only at the end of the year. Okay, yeah, so the way to calculate the surplus expense is like the one that you have seen in this slide. At the beginning of the year, you have to know what is the amount of surplus that you have. At the end of the year, you calculate the amount of surplus you have. So you calculate the difference. The difference is the surplus use. Then you record the surplus use as an expense. So why you debit surplus expense? Because according to the rule of debit and credit, surplus expense increases, you debit. So the surplus expense account increases from 0 to 1240. So debit surplus expense, and you just memorize this: credit account supplies. The surplus account is the account for surplus asset. So when you use the surplus expense increases, the surplus asset decreases. That's why you credit the account surplus asset. Okay, just remember about this, the way to do adjusting entry for surplus. First step, you calculate the surplus expense, and then you record the adjusting entry like this: debit surplus expense and credit account surplus. Okay, I have a sample question here. There are 4 scenarios, and then the question asks you to prepare the necessary adjusting entries. I hope I can prepare a video for this sample question, and then I will share with you the video. Okay, we have done, you have seen all the adjusting entries that are relevant for this course. So this is the end of lecture for today. Do not forget to write your name and matric number in the comment section.